Gold has been described as the ultimate store of value for centuries. The argument for holding it has never been louder than during periods of financial stress. When markets fall, headlines call for a move into gold. When central banks print money, the case for gold intensifies. When geopolitical tension rises, gold prices tend to follow. The message repeats often enough that it has become a default assumption for many investors. This video tests that assumption with identical starting amounts placed into two separate positions at the start of 2004, held without interruption. The first position holds gold at the prevailing spot price. The second holds a broad market index fund tracking the S&P 500 with all dividends continuously reinvested. Both start with $10,000. Neither receives additional capital. At the end of the period, the two positions are compared. The period chosen for this comparison contains two of the most severe market disruptions in modern history. The full period spans 20 years. It was not selected to favor either asset. Both faced genuine stress. Both recovered. And the full arc of each position across those 2 decades tells a story that neither camp in the gold debate typically presents in full. Gold is a physical commodity with a finite global supply that cannot be meaningfully increased on short timelines. It pays no dividend and generates no revenue. It cannot be used to fund operations, pay workers, or develop new products. Its dollar price responds to supply and demand dynamics, to currency movements, to central bank policy, and to the collective perception of risk among investors globally. Gold does not grow in any operational sense. Its long-run track record suggests it preserves purchasing power across very long periods. But preservation is a different objective from growth. The S&P 500 is a broad index of the largest publicly traded companies in the United States, weighted by market capitalization. A fund tracking it holds a proportional share of every company in the index and collects the dividends those companies distribute to shareholders. Those dividends are reinvested back into the fund continuously. This reinvestment is not a minor feature. Over long periods, dividends have historically accounted for roughly 40% of total equity returns. An asset that generates income to reinvest compounds in a fundamentally different way from one that does not. Both assets attract serious long-term investors. Both have records that span decades. This comparison does not argue for eliminating either from consideration. It measures what actually happened to the same starting capital placed into each for the same 20 years. The period runs from January 2004 through January 2024. Gold is measured using the dollar spot price. The broad index is measured using the total return index, which includes all dividends reinvested. Both positions begin with $10,000. Neither receives additional capital across the full period. The 2004 starting point places both assets in a recovery environment following the dot-com crash of 2000 to 2002. Gold entered this period at a historically low price relative to what followed. The equity index entered this period having lost roughly half its value from the 2000 peak and was in the early stages of a recovery. Neither asset was starting from a position of exceptional strength. This analysis does not account for storage or insurance costs associated with physical gold, nor does it include the expense ratios of index funds. A real investor holding physical gold would incur meaningful ongoing costs. A real investor holding an index fund would face an expense ratio well below 1% annually for the broadest available funds. The directional conclusion of this comparison is not altered by these omissions. Gold entered the period at approximately $410 per ounce. At that price, the starting position represented ownership of roughly 24 ounces. The first 5 years of the comparison ended in January 2009 at the depth of the global financial crisis. The equity index had fallen roughly 38% from its 2007 peak. With dividends reinvested, the equity position was worth approximately $8,700. The position had lost meaningful ground. Gold responded to the crisis as its advocates predicted. The spot price had climbed to approximately $850 per ounce by January 2009. The gold position was worth approximately $20,000. While equity investors were absorbing a significant drawdown, gold holders had seen their position double. The lead stood at more than $11,000 at that 5-year mark. Gold continued to rise through the aftermath of the financial crisis. Central banks around the world responded to the crisis with unprecedented monetary stimulus, and the concern over currency debasement drove safe haven demand for gold to historic levels. The spot price climbed through $1,500 per ounce in 2011. It reached its all-time high near $1,800 per ounce in September of that year. At the peak, the gold position was worth approximately $44,000. The equity position, recovering from the crisis low but still climbing, was worth approximately $20,000 at the same moment. Gold's lead had reached its widest point. By January 2014, 10 years into the comparison, the picture had shifted. Gold had retreated from its 2011 peak, and the spot price had settled near $1,250 per ounce. The gold position stood at approximately $30,000. The equity position had continued to rise through the post-crisis recovery and stood at approximately $25,000. Gold still held the lead, but the gap had narrowed to roughly $5,000. The second decade of the comparison period belongs to equities. Gold traded within a relatively narrow range from 2013 through 2018, generating almost no price appreciation across that stretch. The equity markets, by contrast, experienced one of the longest and strongest bull markets in recorded history. By January 2019, the gold position stood at approximately $31,000. That marked 15 years into the comparison. The equity position had reached approximately $46,000. The equity index had overtaken gold, and the gap was growing. The 2020 pandemic brought a sharp shock to both assets. Equity markets dropped roughly 34% between February and March of that year. The decline unfolded in under 5 weeks. Gold surged through $2,000 per ounce in August of that same year as uncertainty drove safe haven demand to its highest level in years. Both assets were moving in their predicted crisis directions. The equity recovery was faster than most investors anticipated. By the end of 2020, the equity index had recovered its losses and was setting new records. Gold's peak, at approximately $2,100 per ounce, proved temporary. The gold price retreated through 2021 and into 2022 before stabilizing. Throughout this period, the equity position was compounding the reinvested dividends from hundreds of companies across the index. That continuous reinvestment was functioning as additional capital working at the prevailing market rate, regardless of what the headline index price was doing on any given day. 20 years had elapsed since both positions opened. The gold spot price had reached approximately $2,000 per ounce by that final January. The gold position was worth approximately $49,000. The equity index total return position, including all dividends reinvested across the full period, was worth approximately $65,000. The gold position had grown by nearly 400% from its starting value. The equity index total return position had grown by approximately 550%. The gap between the positions was approximately $16,000 in favor of the equity index. The compound annual growth rate for gold across this period was approximately 8%. The equity index total return compound annual rate was close to 10% across the same window. That difference of roughly 2 percentage points, maintained continuously over 20 years, is the source of the gap. The $16,000 advantage built gradually across the full period on the same starting capital. The first half of this comparison period represents exactly the scenario for which gold is recommended. During the 2008 financial crisis, gold doubled while equities fell sharply. An investor who held gold from 2004 through 2011 experienced a substantially better outcome than one who held the equity index across the same period. Gold also offers properties that no equity index can match. It carries no counterparty risk. Its value does not depend on the continued operation of any company, bank, or financial institution. In countries experiencing currency crises, gold has consistently preserved purchasing power in ways that local equity markets could not. These properties are real and have been demonstrated across historical examples in multiple countries and across multiple centuries. The limitation of gold as a long-term holding is the absence of income to reinvest. An asset that pays nothing to be held requires a larger price increase to produce the same total return as an asset that continuously generates and reinvests income. Over a full 20-year period, this structural disadvantage compounds into a meaningful gap. Both positions started with $10,000, each held for 20 years without interruption. Gold finished at approximately $49,000. The equity index total return position finished at approximately $65,000. The equity position outperformed by approximately $16,000. That gap represents roughly one-third of the gold position's final value. Gold led the comparison for most of the first decade. The equity position overtook gold in the second decade and widened the gap through the combined effect of market appreciation and continuous dividend reinvestment. Gold came close to 5 times the original investment. The equity index position came close to 6.5 times the original investment. The gap is not produced by gold performing poorly. Gold nearly quintupled the starting amount across a period that contained 2 major financial crises. The gap is produced by the compounding effect of dividends that gold has no mechanism to generate. Over a long enough holding period, that structural difference has consistently determined which asset type finishes ahead. If this comparison changed how you think about gold as a long-term position, subscribe for more documented financial simulations. Every scenario in this channel runs on historical data and real market figures. Drop a comment with how you currently think about gold in your own portfolio. Sources are listed in the description below.